Hello and welcome to Building Tomorrow's Insurer, where we explore the cutting edge of insurtech and digital innovation in the insurance industry. I am your host, Nigel Fellowes-Freeman, and today we are diving into the world of startups, funding, accelerators, mentorship, basically I think everything in between, because we've got someone as a guest today who is across all of these things, and I could not be more excited to be joined by none other than Ian White. Ian, he's a current, this is long actually, so we're going to take a while to get through this, but Ian is a principal of Turbo Ventures. He's a mentor at MGA Labs, where he does a lot of advising for startups. I think that'd be a real theme of today of, what to do and or specifically what not to do in the startup world. Previously, a startup bootcamp mentor and is a founder of multiple startups, including Coffee Financial. And I could not be more excited today for the conversation. So, Ian, thank you so much for giving some of your time today.
Yeah, thank you, Nigel. Really excited to be here. A lot to dig into in different areas. And I do just want to say at the outset, I certainly learn a lot more from my failures than I do my successes. So there's a lot of humility in where I come from.
Yeah, that's. I think that's anyone I ever speak to who's had any elements of success. They always say the scars are the things that teach you the most. And so everyone who's ever achieved anything, I think, goes through a huge amount of failure. What is it? You never you don't score 100% of the shots you don't take. Whatever that kind of that saying is, but that kind of is in and around it, isn't it? So I'd love to start in, if it's okay. I always think it's so interesting to start at the beginning. I think the more you can learn about somebody's story, I think that really kind of sets up the conversation so well. And so, can you maybe talk a little bit into maybe how you got into entrepreneurship? How you got into where did you start? Was it something that you had young, that you were just selling baseball cards at 12? Like how did you get into the world of entrepreneurship?
Yeah, it's a good question because it often gets glossed over. And I went to business school at Babson College, which wrote the book on entrepreneurship. And a lot of what we studied were, family, like lifestyle businesses. But what was it about that from an early age? And in my case, divorced parents, only child, latchkey kid, in the 70s. So he'd come home and, I learned how to, well, maybe it was frozen food. It was certainly before the microwave. And then I learned to, cook for myself. And I was just independent. And if I didn't do anything, nothing would get done. And my parents were both equally supportive in their own way, but I just had to figure out what to do. And I just didn't like sitting there. So complaining only gets you so far. I didn't have a lemonade stand or baseball cards or anything like that. I did make cakes that I sold to my stepfather's restaurant. But that was it. I think what really happened for me was I was working. I finished university in 1992. Although, yeah, I mean, I went to high school in Ireland and studied in France and university in Canada. So just gave me a bit of a different exposure to things. But I started working in the early 90s. And then in 2000, I moved to New York, was working, and then 9/11 happened and you couldn't really get a job because it was a recession. And then I was like, well, what do I do? And so actually I took business school off my resume, and I felt like, damn it, I just can't rely on like the institutions to provide for me. I was on food stamps, I was on Medicaid, supplemental, what was it, like benefits for unemployment ran out. They extended it, but because I was laid off earlier, I wasn't eligible. And then at that point, I was trying to do real estate brokerage before 9/11 happened, and it's 100% commission. You have to prove your income. And I was a bad real estate agent, or it's just hard to do. So I couldn't prove, what did I earn? Well, not much, but I'm still spending 50 hours a week doing it. And all that taught me, like, damn it, I can't rely on the things I thought I maybe could rely on. And then I turned to, as it was, mapping. And originally it was a printed map that used a unique printing technique. Depending on how you hold it in your hand, you see a thematic layer of imagery. For me, it was subway streets or neighborhoods. And it was, yes, akin to this kind of winking Jesus hokey toy you may have seen in Times Square or in the box of Cracker Jack toys. And turn that from a printed product, which got me into bankruptcy only because, working capitalists come from somewhere, to eventually mapping software, because 2006, 2007, Google Maps was on the scene. They acquired a cool company that became Google Maps and had a database of neighborhoods of informally delineated space. Capturing that spatially and allowing somebody to represent it or better yet, act on it. Find me a coffee shop in Soho. That's actionable as opposed to find me a coffee shop in 10012, which is it means nothing to anybody, at least in the U.S. Like postal codes in some cities mean things, but not certainly not in any cities in the U.S. So that's where I started. And I just kind of put one foot in front of the other. And I think the business school education was helpful with like developing a sense of instinct or what to do. I always loved not knowing what's around the next corner, but knowing I'd be prepared for a variety of ways things could go, either really, really south or maybe not so bad, but certainly a lot of echoes all around, which is one of like the principal challenges of being a solo founder, where you, as I say, you tend to agree with yourself until you don't.
That's
Um,
right. That's
yeah.
absolutely right. Yeah.
Yeah.
Yeah. So it's interesting the comment you had there around kind of going to your business school and learning. I actually was listening to something the other day, and Mark Cuban was talking a little bit about this. And I know there's quite a polarizing view of education, and especially specifically higher education on does it teach you the things, like do you actually use it, is it valuable? And I did some higher education. I'd really trying to deliberate it in my mind, and I thought that something that Mark said that I kind of agreed with was it just teaches you how to learn, teaches you how to absorb information, teaches you how to like distill different concepts. And I think if I was to kind of reflect on it, I think that was really a key thing that I took away was the ability to take a lot of information and distill it,
Mhm.
learn new different things, and then apply it to a certain concept. And I think that was kind of a key thing. Do you feel the same? Is that something that you kind of thought about?
For professional education like business or law, I would
Mm-hmm.
say what's most important is the network.
Mm-hmm.
It's so you come out with the same tattoos, the same stripes, and you're in the guild. I went to Babson, which is a very regional school, great reputation, entrepreneurship, but the founder didn't believe in building an endowment. So the alumni base was quite crap, really, and it was really focused in New England. When I
Yeah.
was living in California for 10 years, it was of no help. So if you go to a school with a brand name, there's that. I think by the time you get in, you've developed a lot of these skills already, which maybe goes to like, why are these people getting in if they don't really need the education to begin with because they have the skills? But it can certainly help develop the muscle for what
Yeah.
to do. And so emerging from that, it didn't really matter if it's, consumer packaged goods or financial services. Really, it's just really understanding and most importantly, I think learning from the past because things don't change that much. When I finished in 2000, the cusp of the internet was here for something other than like waiting 2 minutes to download, a 30-second clip of a cartoon. And people thought the world was very different. It ends up like, a lot of fundamental things are essentially the same. It's just business models have maybe evolved, but like book publishing, it's the same. The economics are there. It's just they're different players.
Yeah.
And you're not moving dead trees around, but it's not universally different. There's some that obviously evolve now, but I think it's really helpful to understand that lineage because again, not that much is essentially fundamentally new.
Yeah, yeah. And then take me on that last little piece of the journey, um, which is like digital mapping software
Mm.
into kind of startups, now into like mentoring startups and MGAs. How did you get yourself into the insurance industry?
Yeah, so there's still about 15 years to cover, but I'll get there quickly. So I sold the Urban Mapping, which was the mapping
Yeah,
software company. I sold it in 2013 to Pitney Bowes, which is direct and digital marketing, and then tried something in cat risk, specifically around earthquakes. I was living in California, and the take rate for insurance is quite low. It's optional. It's out of sight, out of mind. The last big one had happened, years earlier and it wasn't priced in a way that made really any sense for homeowners. The principal determinant for economic risk is obviously soil type, but the way the quake insurance was priced was predicated on your postal code, which is utter nonsense. So the idea was to develop a MEMS accelerometer that can understand and tease out the soil type through noise, wind vibrations, buses going by, and the geological literature is quite clear in how to make this translation. And then if you know you're on bedrock versus sand, right? You can price select do a lot more. And that opened my eyes to how reinsurance sort of works because the US market for quake is so opposite of resilient as opposed to say Chile or Japan or New Zealand. I just didn't want to wait around, but I like that. Then I worked for a bit at a company that was in the hedge fund world. They were originally trading. They were aggregating a lot of location related data and looking at the relationship between foot traffic and company earnings. So I was the guy, among other things, doing deals with SDKs and that publishers, bring in lots of this data. And then, the quants would develop these massively probabilistic models to understand maybe what Best Buy's earnings are going to be next quarter relative to expectations. And depending on a lot of fuzzy math, you can deploy a trade and you can make money doing that. Now, this is this world of alternative data, which it really opened my eyes to, and it happened early on. I mean, this kind of opportunity is, I think, pretty much arbed away, but there are a lot of them that still exist. So I hated the industry because it's extractive. I win, you lose. But I love the idea of thinking about what's the data that lurks all around us that we're not thinking about. I've been saying for well over 15 years, one man's metadata is another man's data, which would give me quizzical looks until maybe 5 or 10 years ago. At that point, I was introduced to my then co-founder, who came from a family trucking brokerage business. And I read about trucking, which was, the clear example of the house on fire in insurance, known as the Satan's pit. And thought, well, what better line of business to jump into, bringing a world of alternative data, recognizing that trucks were all connected beginning in 2019. So there was an opportunity to kind of rethink the available data and price the risk more accurately using a lot of data and modern software as opposed to the antiquated way it's been done.
Super interesting. And was there, when you say the trucks all started getting connected, was that a particular company? Was that just that GPSs had started getting installed in all fleets? Was there a specific software that was bringing all the fleets on board and therefore had the data that you could then take out to use for insurance? What was the trigger that got all of the fleets data?
It was a federal mandate. It wouldn't happen otherwise. I mean, larger fleets would use telematics for a variety of purposes, such as fuel efficiency, routing, dispatch, getting to the yard and other things. But smaller fleets, there's no reason for them to do it. They're kind of driving with one hand, talking to their partner / accountant on the other, and there's no way in the world they would. So the mandate was in 2019, earlier, but it slowly rolled out. And so now they're all connected, and because they all are connected, it's an opportunity for a lot of traditional telematics vendors to offer products that kind of cover this full range of complying with the mandate very minimally to having video and a bunch of advanced techniques for larger fleets to manage their business.
Super interesting. And let's pull that through a little bit more, which is insurance generally being risk averse. You now obviously done a bunch of data businesses as well as now mentoring businesses in startup accelerators, etc., who obviously are risk on. And how do you see the insurance market with this kind of risk on push with kind of startups and data driven, et cetera, do you see that as a real the risk aversion for the insurance industry to be a real strength, or actually is a weakness today in terms of how we need to be thinking about market?
Yeah, I think because it's been around, let's be clear, like modern insurance has been around for close to 400 years. So they're doing something right. Now, it's not the fastest. I think, NPS score is probably the lowest of any industry apart from maybe, telco. But it persists. And so, you have to ask yourself why. I think that the wave of internet innovators, I'm using quotes because I hate the term, they came in with the idea of, use more quotes, they wanted to disrupt, which is the absolute worst thing you can do to say to an industry that's rooted in 400 years of tradition and experience. You don't want to disrupt it at all. It works for a damn good reason. What you want to do is make it efficient by taking out a lot of the cruft and modernizing, thinking about standards and interoperability, and the handshakes are still important, but over the handshakes, maybe you can do more than get to know somebody. The transaction piece has to happen as well. It just gets very slowed down by the nature of not getting past the relationship, is sitting down, having the cigars and the dinner, and then the business kind of quickly follows. And it's not data driven. It's astounding to me. Outside, I think, of a lot of the active program space in the MGA world, and by definition, the MGAs are the ones who are innovating, doing the things relatively efficiently and quickly, either through distribution or technologies. A lot of the larger carriers, for instance, have purchased many insurance companies and many other related entities, and they've got strata of systems, and they have to manage all these different systems. They have multiple engineering projects going on to try to consolidate and get one kind of point of view in understanding risk. They'll have multiple systems to underwrite for different lines of business, and the idea of modernizing a large carrier with, forget about the snap of a finger, but relatively efficiently and quickly, is just it's out the window. They're trying to catch up with what they've been doing for years. And also, these people have a huge business. Like they're writing, in many cases, billions a year of premium. Not to mention all the surplus that they have if they're a carrier, and maybe there's the reinsurance business as well. So like they're not going away. They can certainly have bad years, but for them alone, if they can adjust the loss ratio 1 point through some efficiency on the expense side, let's say, that's phenomenal. That can translate to like 500 million or a billion or more in savings. So they have a very different view of what it means to be kind of dynamic or I think innovative. And that's something I didn't really appreciate when I started it.
Yeah, I think that's right, isn't it? And I think if you, what does Charlie Munger say? Like, show me the incentive, I'll show you the behavior. Like the incentives that a lot of those carriers and the execs, as they should be, are shareholder value and quarter to quarter. And you're absolutely right. Putting a expense strategy in place that gives you a point and a half, that's real translatatory in terms of their incentive schemes. And so you definitely can't push against that in terms of people doing what's right for them as well as right for the shareholders. You touched there on MGAs, and obviously you're pretty deep in this space. And what we've seen and what I see is that MGAs are increasingly acting as SaaS businesses as well as underwriting agencies. So kind of software and insurance businesses. I'm really interested in what you're seeing today on that the evolving model of the MGA, and how do you think that's going to progress over the next kind of 5 years or something like that?
Yeah, I think MGAs, like by definition, they have some sort of angle for distribution or underwriting capabilities, and so a lot of that's wrapped up in modern technology that a larger carrier can't do nearly as quickly. So that's why they exist. I think we've been through this cycle, and I think enough people know about what I call the insurtech paradox, which is these VC fueled MGAs getting big really, really quickly. Any monkey with his eyes closed can like grow 300% a year in insurance. It's just a matter of making the price low enough. What that will translate by definition, and prove me wrong, like I'm waiting for it to happen, is you will have like astoundingly poor performance over time, which means your capacity is gone because nobody wants you because you've lost them a lot of money simply because you wanted to grow with what your VC investors wanted. So VCs / what I call impatient capital is probably like the wrong match with venture. With the MGA crowd, but there's tremendous opportunity. But the hard part is getting an MGA off the ground, and what is that funding source? It's probably not going to be private equity because they're not going to touch you if you're nobody and you're certainly starting from zero. So then it comes back to like start off as an agency, develop relationships over time. You'll be EBITDA positive on day one by definition. And then eventually you'll develop relationships and then can, raise some private equity for growth if you choose, or just sell and maybe get the pen. But so therein lies so this is a business which is principally insurance, and it's a percentage of premium and it's commission. So I think that especially in specialty, as risk continues to the cycles become faster and more extreme in many lines of business, there needs to be a way for the MGA how does it advance itself? And I think it has to do with instrumentation or process or technology associated with the risk, associated with the line of business. So if it's comp, it might be an exoskeleton. If it's homeowners, if it's wheels, it might be some sort of IoT or process or computer vision. If it's D&O, there's a fair amount of data that's available. It might be what are people saying publicly, and the list goes on. And not doing that is simply setting yourself up for failure. So I think, and you hinted at this, I think the emerging MGAs will start thinking about two lines of business. One will be the insurance line of business where they're generating premium and taking a commission. The other will be, and this I think will come first, it will be effectively a SaaS line of business, which reflects the fact that increasing MGAs will be able to tap into the risk, to understand characteristics about the risk. Very narrowly, it'll be the risk they insure or want to insure, but over time, it'll be more broad. The more broadly you can understand the performance of solar inverters, the better you can price your own risk. And if you're providing that in a benchmarked, value-added way back to non-insurance customers, but SaaS customers of a business, they're prime candidates for attractively priced premium for risk that you already understand. And so in a sense, you start off with the SaaS business, and then you could kind of embed the insurance. I don't think about it as an embedded sense, but I see one feeds the other. It doesn't have to be you're selling necessarily the SaaS revenue, the SaaS business generating the revenue, but it could be value add. It could be a new product. It can get you into an adjacent market as well. But there's a bit of a rub because you can't, as an MGA as a startup, you can't be in too many adjacent businesses at the same time and what's your focus and all the rest. But if you just think about it from the MGA perspective, it's you grow slow quickly. You grow slow over time. It's not quick. And so what do you do in this modern era? And it's just a wealth of other data that's being ignored. And so I think that's going to be a really successful way over time for MGAs to grow.
Yeah, it's interesting. There's actually a business in Australia called Safety Culture. They're big, meaningful now in Europe. I think they've got a pretty big presence in the UK, in the US now, and they're like an audit business. So they have people that go out and complete audit forms in terms of safety of a workplace. And they have got an enormous amount of businesses that have got tracking the safety of those buildings, and the fire extinguishers and the roofs and the doors and all of the things that you would want to be able to have as elements that go into a risk model for a commercial building. And so they have got now started they call it, I think it's Safety Care, like an internal MGA that writes that workers comp and commercial property business, etc., all within the business itself. And so exactly what you're saying there, which is provide a service, essentially getting data in, then to be able to help write the MGA business really profitably is something that we're starting to see, I think, through like you say, kind of SaaS businesses into MGAs.
Yeah, but I think like the kind of corollary is like the businesses that aren't doing this, meaning like the mainline carriers, they're just going to start declining more and be more and more targeted in their underwriting guidelines and not be able to find the stuff that's really appealing. And a lot of the heuristics and convention is going to continue to apply. Meanwhile, I think the MGAs will continue to show the growth, as they by definition will, but they also can see risk in ways that incumbents just simply can't see, and it's going to become increasingly important. And there's no real way around it. It's just, in a sense, again, I'm new to this, only 8 years in, but I think it's just darn silly that it's not considered in this way. In addition to that, I've got a whole kind of way of thinking around data that's being used through the policy lifecycle. So say, for instance, in claims, using a piece of information to help better inform the claim. Well, what happens with that piece of information after a claim is paid? Well, nothing. It just sits there. It's maybe, in some database that the TPA has, or maybe it's in a form somewhere, but it's definitely not coming back and being used for selection, underwriting, pricing, loss control, or anything else, but it damn well should be. And so the MGA of the future is going to become much more agile to think about data. And effectively, like I would say, one of the KPIs is basically how many systems, how many steps does that piece of data touch? There used to be this approach, I think it was the Harvard Business Review years ago, and it was like a day in the life of a paperclip. And so the idea was like, here's a document in an organization, and that document is, has a paper clip attached to it because they used to. And then how many kind of hands does it touch? What's the progress that it makes? In what ways is it used? And you could maybe have some meaningful metric there. But I think with the data piece, I mean, you want to be able to reuse this stuff. It's an asset. You don't want to just pay for it and then have it sit somewhere and effectively not know what you know. Like if your claims told you, think about this from an econometric perspective. If you're seeing a disproportionate amount of your claims have to do with Toyotas, like, does that say something about the broader market about Toyota vehicles writ large? Like, you may not know that. Like, Toyota doesn't know that. The universe of consumers may not know that. That's potentially really valuable insight for a number of ways. I don't know how it can be monetized. I do, but there's no direct way. There's no one way to monetize it, but it's really quite valuable stuff. But if you're not thinking about things in that manner, it's not going anywhere.
Yeah, and you mentioned 5 or 10 minutes ago around the multiple systems within the carriers, and I just want to kind of get your views on this, which is we see exactly the same. 10, 15 different systems within the carriers. They've been very heavy in acquisition and M&A, and therefore generally just don't just bolt the thing on, and it sits in its own business line in terms of so there's no central data warehouse that they can then do lots of this analytics from. And so I think there's a really big inherent problem there. And the solve for that is do a 15-year transformation project that tries to use a Guidewire or Duck Creek or whatever it is to choose the new core system. And they just never get off the ground, or if they do, they take 20 years and not 5, and all of those kind of things. And so do you see any outside of the MGA, if you're looking at specifically into the carriers, do you see a path for them to solve this data problem? Is there any things that you say to your startups that are trying to work with these businesses and of ways to solve this data problem?
Yeah, I mean, they're the startups want to sell to the incumbents, and
Mm.
incumbents can only move so far in a shorter period of time. You can do these POCs with the innovation groups that tend to be one-offs. They might be helpful for learning, but you're not gonna grow your business on them.
Mm.
But the big guys are the big guys. Like I'm quite confident saying that EDI is still pretty prominent in like a lot of supply chains. And this is like absurdly antiquated technology. I mean, like Swift messaging system for the banking system. I mean, this is like teletype from the 1960s. It's or mainframes. But the point is like these systems work. Or another one is in 3PL world for broking business. A lot of these folks went out of business, like a Convoy or a Transfix and others, simply because the relationships really matter and the handshakes matter and the faxes matter. They don't care about modernizing. So the point is you have to come to people on their terms, on their place, which means the MGAs have to be able to go and pretzel themselves to support the carrier business in the way that the carrier wants. I think it's very hard for the carrier to simply reinvent themselves. I mean, they can't. They've got very different issues at work. They're not so concerned with one line of business that it takes precedence over every other project. But if they can find commonalities across, all different lines where uh, there's a bunch of hidden administrative cost and expense cost and claims, they can address that wholesale. But that's not easy, and that's like a multi-decade initiative. Then you've got new technologies on top of new technologies, and like what are they doing with Gen AI now? Well, in some areas there's a lot of help, but in other areas it doesn't matter because they're still dealing with ERP from 20 years ago and haven't made those jumps yet.
Yeah, there's again just on the Australian perspective here. There's something that was launched 2 or 3 years ago called open banking, and so banks had to open up their data to essentially the consumer owning their own data and could share it with whoever they wanted, and that is billed to come into the insurance sector. It was meant to be at the end of this year, but I think it's going to get pushed a little bit. And the real challenge for carriers there is how do they make that data exposed? Like how do they build the APIs to be able to allow a customer to request their information and then share it with a party that they want to. I think if that gets to fruition, if that gets to production as it's supposed to, and obviously it can be policies, it can be mandated. So there's going to be a
Yeah.
lot of money spent on doing it. Then the ownership of the data then opens up an enormous amount of capability. And whether that's, I suppose you can think about it more like a decentralization of the data, really, in terms of the customer owning it. So I think an interesting step, an interesting thing to happen. But if we look at what happened with the financial services here, it was meant to happen in 2 years and it took 7. And so I'm sure the insurance industry will be similar somewhat in the open data. But do you have any views on like data decentralization and like how
Yeah.
those business models can get impacted?
Yeah, I think like standards is a big one. So in the reinsurance industry, it's unbelievable how many thousands or millions of hours are spent with really high paid actuaries and others just simply like understanding names of columns and making them so they're normalized so that cedents can talk with reinsurers and get deals done. And it's this mad frenzy that comes up to 1-1 every year, and it's going to continue to the end of time because there's no incentive, unfortunately, for reinsurers to kind of let go and use a system like a supersede. I mean, I think they've got some adoption, but somehow I think a lot of reinsurance brokers they think that what they're doing is very important and it's somehow a proprietary advantage. It just blocks everything. And you can't get around that if that's how they view the world because you need them to participate. I know that in the US you have Epic, which is the large electronic health record provider. They've been kind of forced to open up, but it's been a closed universe for them. So that introduces some new competition. This is actually the last Trump administration was able to develop rules to force health insurers to publish their rates because this is somehow deemed a trade secret, which is patently absurd. But a lot of insurers just wouldn't comply and they just pay the penalty because
Wow.
they don't want to. And then, you pay them, they penalize hundreds or thousands of dollars a day. It just doesn't really matter. So that's the other thing that might not happen. Just because it's available in theory doesn't mean in practice it becomes useful. Or the choke point becomes something else where if you want to be a fintech, maybe the bank doesn't really allow you to do a lot of the underwriting. They want to retain all the authority because of you have a lot of blow up to happen in the US. We had Synapse not that long ago, and the bank behind it didn't quite get a handle on what they were doing. So I think the choke point is going to move all throughout the value chain. It's not going to simply going to open things up overnight.
Yeah, that's interesting. Is there a talking maybe to like, jumping into the startup world a little bit here? Have you what evolution have you seen? You've been tapped into the market, you've been tapped into startups for a while. Obviously, you run one, you now mentor some. Are you seeing changes? Are you seeing? We spoke earlier about the disruptor to moving more to the enabler. I think we saw that again in financial services. I think we saw a bunch of folks come out and want to disrupt a bank, and now all of a sudden everyone's partnering and enabling. And I think we're seeing the same, in my view, in the insurance world. But I'm interested in what you're seeing on the ground, specifically in the US, in the US market.
Yeah, I think that's right. I think in the waves of insurtech, which by the way is a silly term, whoever coined it, but it just reflects that by default, insurers don't use technology. Somehow the innovators are the ones that simply use technology in a meaningful way. But there was this first wave, which was, I guess RMS and a bunch of others for cat modeling, I think in the 90s, and Karen Clark pioneered this stuff. And then there was maybe another wave, and maybe I'm missing something, but let's call it like the Lemonade, Hippo, and Roots. And these are personal lines of business where you had efficiently priced businesses, so the combined were fine. But a lot of them were started by people who had some personal experience or dissatisfaction as opposed to coming from industry. And as a result, you're kind of pushing technology into a place where the business is already priced fairly well. They did some great things with distribution, but they're not making any money. Lemonade, absolutely not. Great manipulation with language to kind of obfuscate and confuse and adjusted EBITDA. I think Root's starting to do something, Hippo maybe as well, but let's be clear, it's been like, investor capital over the last 10 years. I'm sure it's burned through over $1 billion, and they're not profitable. What they have done is burned a lot of reinsurance relationships for other folks coming in their wake. And it sends a mixed message about what's the opportunity with insurtech. A lot of VCs will think going public is the end state, but for companies, that's just where you start. So then there was a second wave of, well, let's get away from these distribution personal lines where we're not really getting deep into underwriting or rating factors or other things. Let's require more domain expertise. Maybe it's B2B where you have commercial lines, bigger policies, marketing's not as much, and that's where I think coffee inserted itself as a trucking MGA and tried to do things properly. Some of the challenges that are still present there from a venture perspective and inpatient capital perspective is this tension between growing really quickly and having decent operating results. And unless you're big enough, you're not going to be able to get the capital support you in your working capital requirements. And that's something that insurance well understands, but a lot of inpatient investors simply don't understand it. They just look to the highlights and think they can do the same.
Yeah, I think it's also reflective in when you think about from a venture funding perspective, there's not a lot of insurance domain expertise inside VC funds. I think there's a reasonable amount of fintech experience or banking or financial experience within the fintech areas within the VC, but specifically insurance domain expertise is somewhat lacking. And so when you try and take a SaaS playbook or a fintech playbook and apply it to an insurance business and expect the same, as those things just don't work, especially as an MGA when your loss ratio is really important. Like that is, you can try and dull it up as a technology business, but if fundamentally you're an insurance business, then the loss ratios are important. And so I think there's some of that was not that well understood, specifically within the VC sector.
Yeah, it's not at all understood. It's like it was baffling. I've been in easily dozens of meetings where like they wouldn't mention loss ratio. They wouldn't ask anything about reinsurance. They don't understand it. They just ask this silly thing called ARR, which is nonsense. And I remember one sort of arguing with me about why can't I tell them my LTV to CAC, and I was like, well, my CAC, I have an agent, and they're compensated by bringing me business and by renewing that business, and my CAC it's effectively fixed. I mean, I can get the commission down over time by doing some other things, but like, what are you talking about? Like, let's discuss what really matters, which is how we grow distribution, how we get in states, how competitively our product, our rates informs. might be different than the incumbents. We have more segmentation. Our lift curve does this, but they don't care. I mean, they're just smart individuals. Like they went to great schools. They could probably, do beat me in a math competition, but they're really dumb when it comes to understanding something new because it's not efficient for them to learn something new about an industry that they're not going to spend full time in. So there are a couple insurtech oriented firms that I think are pretty smart about this stuff, and they'll have insurance executives working there or as partners. But the generalists that got into it, they don't know anything about it, and that's one reason they fled, because they didn't know anything about it. Which is the same reason you'd find these generalist investors going in and out of markets because it's hot and they want to take a couple bites, but then they realize they got burned and they leave. If they stuck around, they'd learn a lot and they might make some good bets, but that's not how they're designed. So I understand it. It's just frustrating to waste a lot of time with them.
Yeah, yeah. And when talking about the MGA and distribution, we're seeing a reasonable amount of carriers dip into embedded and dip into different channels in terms of distribution, the ecosystems, and how can you bring insurance to the point of sale, bring the insurance to the moment of need. And you see carriers, Chubb Studios, those kind of folks starting to build things that are capability there. Are you seeing that within the MGA space as well? Like an MGA is thinking about distribution of how they get their products into a customer's hand? Is it all still intermediated? Like, have you got any views there?
Yeah, I think with certain personal lines, it might be embeddable in an easier way because it's maybe a natural outgrowth of what you're buying. So
Yeah.
I mean, here's an obvious one like auto rental. I mean,
Mm.
it's just like infuriating to go to like the Avis website and let's say the rental car is 40 US a day and the insurance is $40 a day. And by the way, they're not looking at my motor vehicle record. They don't know my driving history. It's the vehicle I'm renting doesn't really matter. Where I'm renting the car, meaning New York versus San Francisco versus Tulsa, doesn't really matter either. There's obvious opportunities there. There's some folks who are doing it. Travel insurance is a great one. I'm not saying it's successful product, but the ability to embed it to give the consumer that ability makes a lot of sense. I think within homeowners and renters, you could flip it where you're getting insurance, but there are other non-insurance things you'd like as well to further mitigate the risk, like maybe you're selling a fire extinguisher or something else. And that might be an interesting indication for selecting the risk on renewal. They didn't want to buy the fire extinguisher. In commercial lines, it's a bit different. So I'll use the example of in trucking where we focus on the SMB. So it's roughly 1 to 100 trucks in a fleet. And we'd have some investors and others who would just love to talk about how we should embed this. It's like, well, here's what's going to happen. You have a trucking company with say 5 trucks. They're going to, buy a new one. So they walk into the local Volvo dealer, buying a new truck. But guess what? Like they already have existing coverage with, let's say, coffee. Like the owner is not going in and buying a truck on his own. You can't have 2 insurers for your fleet. So that means like you can't buy it doesn't make any sense as a practical matter. So there's a big difference between the high level, let's embed all this stuff, and actually how does it work? So starting from the buyer and working backwards to make sure it all fits is a much more of an effective way to do it. And there is still a lot of opportunity. It just takes a much longer time to do it. I think that a lot of the tech is there to do it, understanding their business relationships. There's still a lot of friction that I think needs to be better understood, but it should grow over time. I take issue with some of the statistics I've seen, which is something like, embedded insurance will effectively like outgrow all of P&C because somebody doesn't know what they're doing when they put the chart together. But I think there is still tremendous opportunity in a lot of areas for that.
Yeah, and if it's not embedded for an MGA, specifically on the commercial side, is it what do you advise your startups on in terms of GTM? Like how do they best
Yeah.
go from 0 to 50 mil of premium and then 50 to like what's the cheat sheet for you in terms of go to market for those folks?
Yeah. I mean, for us, and I think in general, you want to try to have relationships with the producers who understand your business. So you could you can go wholesale and just like stuff it all through. That's an approach. We work with specialists in trucking that were big, but they were specialists, and we would effectively give them quasi exclusivity over a market for a period of time if they hit certain premium.
Right.
So that made them like they wanted to keep it for themselves. Now that's a great way to enter a new market. Once you're in end markets, you can't really do that anymore, but you're actually unknowingly creating the producers to compete against themselves for a product that's not broadly available. So scarcity breeds demand. So that's one way to kind of start it off. Offering other value-added tools and just relationships with the agents as a way to do it, and ultimately understand how do they do their business? How can we make them more efficient? So if we can get them to use a portal or a technology, do something other than like the same old stuff they've been doing, or maybe it is the same old stuff, but we're somehow smarter about taking the submission via email with the 300 attachments. If we can do things that save them time, they're going to have more time and they can make more money in a shorter period of time. That's worth it. Are they spending 2 days putting together a submission? If we can cut that down to 1 day, they have more time for another submission, which means they're taking home more. That's what they really want. And that's going to attract them because not all their markets are thinking like that.
Interesting. And is there any world in which those agencies go direct and not
Yeah,
intermediated?
I think there is, but I think you have to really think through what it is. And, if you want to compete against some of your former distribution, how are you going to do that? In what way? One thing we started doing at Coffee is we didn't quite get there, but we were developing a credit card. And so that's something we didn't want our agents to sell because they just don't understand it. Why would they? But if we could use the credit card as a way to better understand risk, underwrite them for the card, maybe we decline them, maybe we take them, but then we could potentially have an application already vetted, already filled out. Then we give it to our brokers and we say, normally get 11%, now you're getting 6%. But by the way, you don't have to do anything.
It's all done.
Yeah. And they still keep something for doing nothing, and that's not bad.
That's not a bad thing. I could speak to you absolutely all day, Ian. Now, I'd love to just take you into the future just for a little bit. We are having this podcast. Actually, before we go into that one, I'll ask you one other question, actually, which is there anything that I haven't asked you that I should have asked you?
Yeah, I think so. I'm not an insurance guy by training. I don't have any of the credentials. So I think about it a bit differently. I know a lot about trucking, a lot about specialty, policy admin, third-party data, some compliance stuff. I've got a big hole in my head for a variety of things, and that's how it is. I used to have imposter syndrome, but this is what you get with me at this point, and I know enough to ask when I don't know. But the way I look at opportunities in business, in insurance businesses, is probably unlike a lot of like traditional underwriters and executives that run lines. And I think about it in this way, and I've been saying this a lot recently, is what's the opportunity today? And so how do you define that as, let's say, a roll-up strategy? Well, do we have an angle with distribution? Do we have proprietary data? Do we have a market cover? Do we have insights that nobody else knows? The last thing I want to do is buy, let's say, an MGA if they're performing at market, because eventually everybody should perform at market. And the way they should do that is they'll just use like third-party data that everybody's using. So I want to use proprietary data that I have that nobody else has because it gives me an edge. So that's kind of one way of thinking about it. Another is, where's the risk going, not where's the risk today? So let's say like satellites. So I think in the last 3 or 4 years, you've had as many satellite launches as you've had in the previous 30 years, right? Like they're going up like nobody's business, and the risk has gotten far, far better. A lot of these, by the way, are not insured at all. And the reason is that I think it's Lloyd's where these things happen. And if you're underwriting satellites, I'd love to talk with you, anybody listening from Lloyd's. But I get the sense they're like thinking about it with slide rules and from a 30 or 40-year-old perspective, because it just hasn't really advanced that much if you've been doing it for the last 30 years in the way that a frog doesn't notice the temperature of the water is going up. So recognizing that there's a crap ton more of launches going up, they're not really insured. We can think about interesting policies that that carve out a lot of things you don't really want to insure for because you won't be able to do it. The policy types can get really interesting as well. Does that not represent like an emerging opportunity, like a next generation? Also space, like liability, what does that even mean? So you can wait and sit back till all that stuff is figured out over the next 20 years, or you can jump in now. Now, I'm not an actuary, so I can't do a lot of the modeling to determine what the risk is, and certain actuaries will be incredibly conservative, others will be more aggressive. But that's like a series of lenses that I use to think about, is this an interesting opportunity, as opposed to like, the same old ones.
Yeah. Wow. Inspirational, Ian. And so 10 years time, we're having this pod, having a conversation. What does the insurance world look like?
I think it's a lot more data driven because other industries have effectively got, like, there's a lot more offshore reinsurers, a lot of ILS has crept into new areas. So what insurance finds is it's losing its lunch in a way that, this is just occurring to me now, but the way that private credit is going gangbusters, banks have lost the lending business. Why would you ever lend from anybody other than the bank? Well, because banks don't understand my business, and they're regulated in a different way, of course, but banks lost out to private credit. So private credit is taking off, that I think the way kind of ILS and other reinsurers will start thinking about insurance related businesses. Being a front is not necessarily a great business on its own. There are ways around that, but it's still necessary. I think the growth of E&S will continue and proliferate. In the US, you've got this weird distinction between the two. But I think cycle times will reduce. This like annual 1/1 thing will persist, but it's going to be a lot faster, a lot more dynamic. I mean, I've been on reinsurance treaties where we're 6 months past the treaty renewal date, nothing is signed. There's kind of a handshake that happened, and people honor this stuff. And this is the beautiful thing about insurance, and they always will. But even so, we just have to find a way to move ahead more quickly with increased confidence. Right now, it's let's not move ahead because we don't have the confidence. And I think eventually when the next generation of young leaders become the senior leaders, they will have grown up with the technology that will give them the additional confidence in seeing the data, in seeing the patterns. We also know that like machine-derived behavior from monitoring, let's say, a risk, I think we'll be able to understand it in a better band of activity, right? Meaning that, let's say you're looking at, use the example of inverters for solar. They're only going to act within a certain band. You don't have to have 5 years of loss experience to understand how a GE versus Siemens inverter is going to behave. We know it, and we can extrapolate to all kinds of fancy math. Won't be perfect, but we don't need that much time. And the actuary is going to recognize that their skills are going to be increasingly valuable when they start thinking more probabilistically as well, which also gets dangerous because if you're dealing with probabilistic math and you're insurer, that's a recipe for disaster. But there's just a lot more you can do between where we are today and like pushing the envelope. They're not at all thinking about that as well. And it's doing that through programs, through other kind of risk type vehicles where you're effectively sandboxing, experimenting, and trying to do it a bit more rapidly than folks are today.
Love it. Absolutely love it. Ian, well, look, your startups are very fortunate that you're mentoring. I'm sure we'll keep our eyes out for them. Please make sure you link them when we kind of put this up. Put some of those startups in there that we're cheering for, and we'll make sure we kind of give them some love. And so, look, thank you, Ian. Thank you so much for your time today. It's been absolutely fantastic. I really enjoyed the conversation. So, yeah, thanks for carving out some time.
Yeah, my pleasure. Great to be on the show, and thanks so much for your time, Nigel.
Pleasure. So thank you everyone for listening. If you want to see myself and Ian's faces, jump over to YouTube. The link will be in the description below. And as always, if you want to hear more from some industry leaders who are pushing the boundaries of insurance, please do check out our other episodes of the podcast series, Building Tomorrow's Insurers. So from Ian, from me, thank you and have a fantastic day.